It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Hello there, it's Tyrone Jackson, and welcome back to another episode of Trading Stocks Made Easy. Okay, let's get right into it. This episode is all about trading in sectors for the next 52 weeks, okay? Rarely have I talked about sectors in this market, but I think it's time you and I have a little chat. So the number one rule, if you're in the wealthy investor sphere, is that you never, ever, ever invest in pharmaceuticals. Why? Well, you know how I'm always talking to you about top-line revenue for your stocks, and that makes the stock go higher over time? Well, when you're in the pharmaceutical business, the way that they make money is by selling drugs to the open market around the world, right? So the most important thing in a pharmaceutical company is to have multiple drugs in your pipeline. Well, you and I don't really understand what drugs fight cancer or Alzheimer's or the central nervous system, and it's very hard for us to determine how that particular drug or a particular drug can be distributed worldwide once it receives FDA approval, and how the company is making money off that drug off license. So in the pharmaceutical business, drugs can be exclusive, and then there's a period of time after that exclusivity period where it is any other company can reproduce that drug. This all has to do with antitrust stuff, and it's very, 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 very complicated. This is the easy way to lose money, is to start trading pharmaceutical stocks. Why? Because drugs, when they're approved, go through these various phases here, these trials, if you will, with the FDA, right? Right. Well, when the drug is near completion, very often a company's stock will rise as it gets towards the end of a trial period. Now, there are actually people who are really good at running these trials. They know what the FDA is looking for, and they know how to position the drug so that it's approved here in the United States, et cetera, et cetera, et cetera. Well, these pharmaceutical stocks are extremely, extremely volatile because if they come up with a new drug, it can literally make billions and billions of dollars for the company in the first 36 months of release in that exclusive period. However, if the drug is declined, all that money that was put into developing the drug, the cure, the research, et cetera, the pharmaceutical company loses. So, this is a terrible analogy because drugs save lives around the world, but it's like Netflix developing a new series. If they put up, $6 million for a new TV series and they release it on their streaming services and people don't like it and don't watch, they're out the $6 million. Well, it's kind of similar in the pharmaceutical business, right? You're putting capital at risk, hours and hours of research, and if that drug never makes it to market, guess what? Instead of a $6 million loss, it could be a $1.6 billion loss just trying to get a drug to market. So you and I, as smart, wealthy investor types, never invest in pharmaceutical companies. We don't trade them. We don't hold on to the stocks as long-term investments because it's just too risky. Remember, when you're studying with me, it's all about monthly guaranteed income that you can count on both in what we call your cash account and also in your retirement. Now, initially, it seems like you want to take the ride with the pharmaceutical company because it's a lot of fun. But I'm here to tell you, I watch people all the time lose tens of thousands of dollars because they don't know what they're doing. They're in a high-risk arena, and it's just no fun. The stocks that are going to make you the most money in the next 5 years are going to be those steady Eddie companies that have revenue stories that you actually understand. Let's just break it down to its most simplest components. If you are trading a semiconductor company, semiconductors go into telephones, cell phones, and other electronic devices. So the only thing you really have to know is how many semiconductors actually went into how many devices around the world, and how is that company making its video semiconductors faster, cheaper, but really great so they can take that semiconductor to market. You see, when it comes to investing, you have to have a financial education because it's not only about the stock price, but what the company does and how it makes money off of the products that it manufactures. The world of pharmaceuticals just way too complicated. So today I thought I would go over with you 3 sectors that I like that have been steady Eddie as a sector. We'll talk about a few stocks in that sector, but they've done really well for me. They will continue to do really well for me. I hope if you find value in investing in a particular sector, it does well for you. But most sectors I'm going to talk about today have done well over the last 5 to 10 years. They're steady Eddie. Okay, so let's talk about one of my favorite sectors, which is the credit card processing sector. Right? Or now sometimes they refer to as the payment processing sector. So I think you've had this experience, and I think you'll understand what I'm saying. You know, when you're shopping on something online on your favorite company website to get whatever it is, car parts or hats, clothing, whatever it is you order online, you have noticed, I'm sure, and think about this for a moment, you can't put a $50 bill into your computer, right? Right. The way you're going to make that purchase online is through a credit card processor or payment processor like PayPal, or they used to call it Square, but now it's called Block, ticker symbol SQ, or you're going to use a Visa, Master, or Discover card. Now, what I love about the payment processing sector, they're essentially toll takers. So let me give you this visual. Have you ever gone over a bridge and had to pay a toll before you decided to go over the bridge? Let me ask you a question. How many times have you gotten up to the point where they're about to take the toll and you said, what? This is $2 to cross this bridge. I'm not going to pay that. And you decided to back up and find another route. Has that ever happened to you? No, it's never happened to anybody. We pay the toll, we complain, and then we move on to our destination. Right. Well, something like that is similar on the credit card processing side of things. So when you pay something, let's say you pay $49.95 to purchase something online, although you were charged $49.95, the merchant who sold you the good or service actually is paying a series of fees on the other side of that transaction. So they don't actually get the $49.95. By the time all those fees come out, maybe they get $47 or $46, depending upon who they're allowing to actually process your credit card instantly. Well, that company gets a fee for that. And PayPal is one company that has collected billions and billions of dollars in fees, not only in online transactions, but also now they're practicing ubiquity, and you can use PayPal in places like Home Depot, right? So the more credit cards that are processed, the larger their fees, which means that feeds that company's what? Top line revenue, the amount of money that they're making per quarter. Now, without being a certified genius, what quarter is the busiest for credit card transactions online? Let's see. It wouldn't be quarter 1, January, February, March. Nah, it's generally a slower time. You do have Valentine's Day, but probably not going to work there. April, May, June, well, sales go up because people have paid off their Christmas debt. Over the summer, you might get another spike there because people use their credit cards for Airbnbs and auto purchases and things like that. Oh, I think I got it. October, November, and December are peak periods for payment processing companies. So that's when they make the most of their revenue. So since online shopping has basically presented itself as a generational shift for buying things online, then payment processing stocks see their revenues rise dramatically in the fourth quarter. Well, how have the stocks behaved over time? Well, we know Visa and MasterCard is a member of what? Not only the Dow Jones Industrial Average, those top 30 stocks, but the S&P 500. And that's a pattern as an investor that I'm looking for. Stocks that tend to go up 100% over a 5-year period. So I not only like the payment processing sector, I love the payment processing sector. Why? Because they're constantly collecting tolls. You see how it goes? Right. So every stock has a story. What do I mean by that? That means how does the company generate top line revenue, gross revenue. And after that, if you look on the balance sheet, there's bottom line revenue and EBITDA and all those things that you don't need to worry about right now. I'm just trying to paint a picture that results in you getting wealthier. So payment processing stocks, or the payment processing sector, has done very well for investors over the last 5 to 10 years, basically for the reasons that I have just explained to you. All right, let's move on to the next sector. The next sector would be the insurance companies. Now, I was joking with an actor friend of mine because, in your state, it is illegal to drive a car or have a house without insurance, right? The law forces you to have insurance on your home and most of the time on your automobile. Well, if the law says you have to have insurance, guess what happens to insurance premiums over time? They ultimately rise. You know this, the more coverage, right, that you get on a particular policy, the larger your premium. See, this is why the insurance companies have made billions and billions and billions of dollars just last year alone, because they're betting that you will not get into an accident and they just collect your premium, whether it's charged to your credit card or you send in a check. The law says you have to have it. You are required to have insurance on your home, condo, townhouse, and your automobile. And boy, oh boy, if they can bundle your insurance for everything, including life insurance, how many times are they collecting premium, right? All right. Now, just as a quick aside, isn't it interesting, as covered call writers, we sell options, also referred to as premiums. That's why covered call writing is so lucrative, particularly in bull markets, because like the insurance company, all you're doing is collecting payments for selling rights. It's not even equities. All right. So I like the insurance company. And I was joking with an actor friend of mine. Have you noticed that the way insurance companies market themselves, particularly on television, is they start out with one identity. So there's one company that has a character named Flo, and she's been on that gig for, I guess, about 11 years. But have you noticed that Flo has friends now, right? Flo not only has friends, Flo and her friends are the cast that you find in these commercials, almost like a TV show, right? So now you're getting to know not only Flo, but all the cast members that make up the insurance TV show, and they change these commercials all the time. Why? Because they work. Instead of a company saying to you, hey, we'll lower your rates, they are now producing characters that you start to identify with, and those characters really sell you the insurance. Isn't there somebody on TV right now with an emu as a pet? Yes. Isn't that an insurance company? Yes. That emu and that actor are what? Are a cast, almost like a television show. Okay? And have you ever been in good hands? Isn't there a very handsome actor who tells you with a very deep voice, with this company, you're in good hands? Yes, but they also created a character named Mayhem. I'm talking about, of course, Allstate, right? So they get you to buy into the idea that you're in good hands. And if we can bundle your home, car, and life insurance, we'll give you a little bit of discount on everything, as long as you keep all your insurance with us. So investing in the insurance sector over time has done very, very well. However, the insurance as a sector doesn't do as well as, let's say, semiconductor companies, because Wall Street really likes investing in technology. But you can invest in stocks like Progressive and Allstate because they're publicly traded. Now, every once in a while, I'll trade an insurance company. I don't really like the insurance business, and I'll tell you why. Even though they're constantly collecting premium, I don't like insurance companies because when there's a catastrophe like an earthquake, a fire event, or something big that impacts the United States, they have to pay out a lot of money. So who do they turn to? Reinsurance companies. In other words, if Allstate had to pay out $1 billion, it doesn't all come from their pockets. They go someplace else and they get insurance. And that process is called reinsurance. So whenever there's a fire, let's say in the state of California, that's of a magnificent magnitude, Allstate has to pay out, but what they do is they raise premiums on everybody throughout the United States, not just in the state of California. Because if you live in the state of California, it's not your fault that that large range fire hit your community. So everybody in the United States winds up paying 50 cents more, $1, $2 more per quarter to retrieve their funds. And they never tell you that. But you have to read the income statement to find out where the revenue's from. So I'm not a big fan of the insurance company because inevitably people will have a car accident. There'll be something tragic that'll happen. The insurance company will pay out. Premiums will rise. And dividends on the stocks don't rise as fast as these catastrophic events. So not a big fan of the insurance business as a sector, as a group of stocks to trade and invest in. So when we come back, I'm going to talk to you about another sector that some of you may be attracted to right after you listen to this.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
Hey, it's Tyrone Jackson, Wealthy Investor again, and I just wanted to remind you that if you enjoy listening to the Trading Stocks Made Easy podcast, be sure to share it with your friends all across social media, including Facebook, Instagram, and Twitter. If you enjoy hearing about success principles that inspire you, as well as interviews with some of my most successful students, I want to remind you it's right here at the Trading Stocks Made Easy podcast, wherever you get your podcast. So today we're talking about make sure you download as much free material as you want at Now let's move on to another sector.
I'll see you there.
I think you're finding this education sort of kind of interesting, right? And the stock market will never cease being fascinating. And there's one sector that I do not recommend, but a lot of people like to invest in, and that's streaming. So we know we have Netflix, which, by the way, just came out with incredible top-line revenue growth, and subscribers in the U.S. and Europe are growing. That's more people you can actually bill every single month, right? Okay, so Netflix now is trading around $300 a share, and the other leader in the streaming business that's publicly traded, surprise, Disney. Now, we know what happened with Disney last year. You see, let me tell you this story just so you know why I'm not a big fan of the streaming business. Disney used to get $2 billion from Netflix 7 years ago just to lease their content. And then Disney decided, well, rather than collecting $2 billion, we have a big movie catalog. We should start our own streaming service. And they wound up doing that. And guess what has happened to Disney in the streaming business? For those of you who did not read last year's earnings, Disney is losing $4 billion a year in the streaming business. In other words, even though they have this relationship with Marvel and all these other companies to produce their content, they're losing in the streaming business. Yes, big brands can try to go into an area of the marketplace, and they're wrong all the time. Even though they have the power, and even though they have the relationships and the monster marketing teams around the world, they can put billions into an effort and still lose money. This is the reason why Disney stock, ticker symbol DIS, has not moved. Because Disney makes its money in a multitude of divisions, but its stronghold is still that theme park business. So guess what? And I'm not making up anything. It's all in the quarterly report. Guess how Disney made up for the loss in the streaming business? They raised the price at the theme parks, and the public still paid it. So they're not accustomed to losing $4 billion a year. They're accustomed to being very profitable. But this little attempt at going into the streaming business has cost them dearly. Now, this is what I love about having a podcast, because we can track it in time, and you'll tell me if I'm right. Something is going to go on at Disney Plus within the next 36 months. The only way out that I see from a revenue point of view is they're going to have to merge with someone to cover these costs. Now, the company that I think they're going to merge with, I talk about in trade school and at the live events. I'm just simply not going to talk about it here because I got to show income statements and show you who I think is going to become Disney's partner to bail them out of this loss. And that stock is going to rise as well, of the company that's going to be their partner. But it's a complicated revenue story that I have to explain. But I'll allude back to this episode when the merger is announced, which I think it'll take about 3 years before that happens. Okay, so Disney essentially is going head-to-head with Netflix, which actually has a net profit. But guess who doesn't have a net profit after all expenses? Paramount Plus? Not quite. Warner Brothers? Not really. Roku? No. You mean to tell me Netflix is the only company in the streaming sector that's actually generating a profit? The answer is yes. All right. Do you see what's happening? Okay. So sometimes when you're trading stocks or you're investing in stocks, you have to educate yourself about the particular sector in the marketplace. I don't have time to go into the semiconductor segment today, but semiconductors tend to be very volatile, almost as volatile as pharmaceutical companies, but you can make a good living there as a trader and as an investor. Well, that's going to do it today. I just want to give you a taste of the idea of having a financial education. It's not all fun and games when you're investing in the stock market. Sometimes you have to become educated about a particular sector. But I'll tell you this, the more you know, the better you are at picking winning stocks. People say to me all the time, Tyrone, why is it you have such a high success rate at choosing stocks or sectors that do well? And, someone said to me the other day, you're really, really smart. I don't know if I'm really smart, really, really smart. I just learned how to follow the patterns in the stock market of which sectors do well over time, and I stay out of the ones that don't. Believe me, I'll take a compliment any day of the week and any time of the day. Really smart? Really, really smart? Well, thank you. That's nice. But you know what? You're really, really smart too. You just need a financial education so that you can start collecting this residual income on a regular basis and change your life. When I talk to you about the stock market, it's not hocus pocus when I tell you you could be rich in 5 years. There really are an established methodologies that you can use to analyze a company stock or sector that pay off big for you. Don't let someone else choose your stocks. Don't keep your money in a mutual fund. Become an educated investor and trader, and you will change your life. That's it for this week. I'll see you next week right here on Trading Stocks Made Easy.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button, and you'll automatically receive our next episode.